Welcome to Talk Tickers. It is Tuesday, February 17th, 2026.
Good to be back.
This is the show where we strip away the corporate gloss, we ignore the PR fluff, and we really get right down to the raw machinery of the market. We're here for the serious market participant.
Yep, for the people who know that the headline number is just the cover of the book.
Exactly, not the whole story. And looking at the tape this week, that story is getting very, very interesting.
It certainly is.
Today, we are training our lens on really the backbone of the entire technology sector.
Right.
We're talking about Applied Materials, ticker AMP.
A monster of a company.
Absolutely. They dropped their Q1 fiscal year 2026 earnings late last week. And to say the market liked it would be a massive understatement.
It was a decisive verdict. There was no ambiguity there.
The market has spoken, and the verdict is bullish with a capital B. We're looking at a tape that absolutely loves what is hearing about the AI infrastructure build-out. But here's the thing, and this is why we're doing this deep dive today. It is not just about the earnings beat. We see beats all the time that get sold off the next morning.
All the time. A beat is backward-looking, right? The market trades on the future.
Right. What we have here is something fundamentally different. We're looking at what seems to be a pull forward of the entire trillion-dollar semiconductor timeline.
The whole roadmap is shifting.
And maybe even more importantly, we found a very specific, almost, a physical bottleneck that was kind of buried in the management commentary.
Yeah, that was the key detail for me.
It's a detail about clean room capacity that suggests this cycle has significantly more room to run than the consensus believes.
And that's the key insight. We're moving from a cycle that was defined by fears of demand destruction to a cycle that's now being defined by physical supply constraints. And that changes the valuation model entirely.
It changes everything. So let's unpack this. We're going to break down the numbers, the technical shifts in chip manufacturing that are basically printing money for AMAT, and then we'll get into this clean room constraint that might just be the alpha signal of the year.
Sounds good.
But first, let's start with the basics, the scorecard. What actually happened? What were the numbers?
Okay, let's run the numbers. So revenue for the quarter, it came in at $7.01 billion.
Okay.
Now, to put that in context, the street consensus was sitting around $6.87 billion. So that is a clean, solid beat on the top line.
Not a small beat either. That's a decent gap. And what about the bottom line?
So adjusted EPS hit $2.38. The consensus was $2.21.
So a 17-cent beat.
A 17-cent beat. That is a solid margin. It's not a rounding error. It points to real operational efficiency.
On margins in general, how did they look?
Gross margins are sitting pretty at 49.1% on a non-GAAP basis. That tells you they have pricing power. They aren't, discounting these huge complex machines just to move them out the door.
Right. And I think you'll agree with me here. The revenue beat and the EPS beat were nice. They were solid, but that wasn't the fuse. That wasn't what ignited the stock.
No, absolutely not. Not at all. The ignition point was the guidance.
Always a guidance.
Management guided Q2 revenue to approximately $7.65 billion, give or take $500 million.
Whoa.
Yeah. And that is materially above where the street was modeled.
And that's the signal. When you have a company of this size with this kind of market penetration, guiding that significantly above consensus, it wakes people up. It forces them to tear up their spreadsheets.
It forces a re-rate. Exactly. And we saw that strengthen the cash flow as well. I mean, they generated $1.69 billion in operations cash flow.
And shareholder returns.
They returned $702 million to shareholders through buybacks and dividends. So, the whole engine is just humming along beautifully.
Okay, so let's talk about the reaction.
Yeah.
Because we could look at spreadsheets all day, but at the end of the day, price action is truth. The stock ripped.
It really did. It closed the next session up nearly 9%.
9%.
Added over $29 to the share price to finish at $357.41.
And it wasn't a lonely rally.
No, that's the key.
It pulled up the Piers Lamb Research, KLA Corporation. The whole equipment sector got a bid.
So what does that tell you? When the whole sector moves in sympathy like that, this isn't just an idiosyncratic win for Applied Materials. This isn't, AMAT stole market share from Tokyo Electron this quarter.
Precisely. This is a confirmation of the AI supercycle thesis. For the last 6 months, maybe even longer, there's been this lingering fear in the back of investors' minds, the fear of the air pocket.
The famous indigestion theory. We've talked about it before. Right. The idea that the hyperscalers, your Google, your Microsoft, your Meta, would have to pause their spending to digest all the GPUs they bought in 2024 and 2025.
The worry was that they just built too much too fast.
Exactly. The market was terrified that demand would just hit a wall, that it would stagnate. This report, and specifically that Q2 guidance, it just evaporated that fear. Gone. The guidance suggests acceleration, not stagnation. The market is now pricing in a scenario where the demand curve is actually steepening, not flattening out.
It's the higher for longer narrative, but you're applying it to capital expenditure instead of interest rates.
That's a great way to put it. It's a CapEx supercycle.
Okay, so the numbers are good. The stock reaction was explosive. But let's get into the why. I want to transition to what I'm calling the macro thesis. The CEO, Gary Dickerson, he came out swinging with some State of the Union style remarks on the call.
He was very direct. No mincing words.
He dropped the T word, trillion. Management stated the global semiconductor industry could hit $1 trillion in revenue by 2026. Now, we've heard predictions like this before, but they're usually set for, what, 2030?
At least. 2030 was the common target. He's pulling that timeline forward by years. And that is a bold claim because, the semiconductor industry has historically been tethered to global GDP. If the economy slowed, chips slowed. It was that simple.
But he's arguing that correlation is broken.
Completely broken. The driver is no longer just how many people are buying new phones or new cars. It is now entirely centered on the AI data center.
He mentioned a specific crossover event that I found fascinating. I had to read it twice.
I know the one you're talking about. Yeah. This year, 2026, marks the point where data center consumption of leading-edge wafers passes personal computers.
Think about that for a second. For 40 years, the PC was the king of silicon. It drove the volumes. It drove the lithography roadmaps. Everything revolved around the PC cycle.
And now, the server rack has officially dethroned the desktop. It is a historic changing of the guard.
And he didn't stop there. He said the next milestone is data centers surpassing smartphones by 2029.
Correct. And when you actually look at the underlying growth rates, it makes perfect sense. I mean, traditional data center growth, just storing your photos on the cloud, running basic enterprise apps, that's growing at maybe 10 to 20%.
A respectable but not explosive number.
Right. But the AI-related components, the GPUs, the HBM, the custom ASICs, those are growing at 30 to 40%.
So if you're an equipment maker like Applied Materials, you don't really care about the 10% growth of the commodity stuff. You are laser focused on chasing that 40% growth.
Exactly. And this brings up a really crucial point for anyone analyzing this sector. The old models are dead.
How so?
We used to have this metric called wafer fab equipment intensity, or WFE intensity. And analysts would just say, okay, WFE will be about 15% of total semiconductor revenues. It was a lazy, but, a pretty effective rule of thumb for a long time.
A good enough heuristic. And now
it's broken. It's completely broken because leading edge logic in this new high bandwidth memory, they're growing so much faster than the overall market, and they require so much more equipment per wafer.
So the intensity is higher in those areas.
The intensity is spiking in these specific pockets. It's not a flat 15% across the board anymore. It's incredibly lumpy.
It's all concentrated in the high performance stuff.
And the real driving force isn't just, we need more chips. It is the desperate, absolute need for energy efficiency.
Power usage effectiveness, PUE.
Exactly. Data centers are hitting power walls. I mean, literally, they cannot get enough electricity from the grid to power the next generation of AI clusters. So the only way to scale AI is to make the chips themselves more power efficient.
And how do you do that? You can't just wish for it. You need new materials. You need new architectures. You need to fundamentally change how the transistors are built.
And that plays directly into Applied Materials' hand. They are, at their core, a materials engineering company. When a chip designer needs to change the elements from the periodic table that are used in a chip to lower resistance and save power, you call AMAT.
Let's dig into that, because materials engineering can sound a bit like a marketing slogan until you look at the technical trenches.
It's very real.
I want to break down exactly where this money is going. We're seeing a 20% expected growth in semi-systems for 2026. I mean, that is a massive number for a company of this scale. Where is it actually coming from?
It's coming from three main buckets, three pillars of growth. The first, and arguably the most explosive right now, is high bandwidth memory, or HBM, and the DRAM that feeds it.
HBM is the buzzword of the decade. Everyone's talking about it. But explain the mechanics for us. Why does HBM require more equipment? I mean, a memory chip is a memory chip, right?
Not anymore. That's the key. Think of standard DRAM as like a single-story, sprawling warehouse. Lots of area, but not much height. HBM is a skyscraper. You're taking individual memory dies and you're stacking them on top of each other. We're moving from 12 high stacks to 16 high, and the roadmap goes to 20 high stacks very soon.
So you're literally building vertically.
Yes, and every time you stack a die, you have to connect it to the one below it. That requires incredibly complex wiring and patterning steps. But here is the real multiplier effect, and this is the number that matters.
Lay it on me.
HBM requires 3 to 4 times more wafer starts per delivered bit than standard DRAM.
Wait, hold on. Unpack that for a second. 3 to 4 times more wafer starts.
Yes. Because the individual die size is larger, the yield challenges are much higher, and you have to include a logic die at the base of the stack to act as the controller. So to get the same amount of final memory capacity into a system, you have to process significantly more silicon through the factory.
Which means you need more machines.
A lot more machines. That is a massive equipment intensity increase.
That's the aha moment. So even if the demand for total bits of memory stays the same, if your mix shifts from standard DRAM to HBM, your equipment demand triples or quadruples.
Roughly, yes, for that portion of the market. And Applied is just cleaning up here. They stated on the call they are #1 in standard DRAM, #1 in HBM DRAM, and #1 in HBM packaging. They're winning on the specific wiring and patterning steps needed to connect these massive stacks.
And I noticed they also mentioned the transition to something called 4F squared architectures in DRAM. Now that sounds like deep jargon, but it basically just means shrinking the memory cell size even further, right?
It does. It's a new architecture that changes how the capacitor and the transistor are arranged in the memory cell. It's a huge technical challenge. It requires new materials and extremely high precision etching. And again, that's a share gainer for Applied.
Okay, so that's memory, pillar 1. A huge driver. Let's talk about the brains of the operation. Pillar 2. Leading edge logic and foundry. We're seeing this huge transition from FinFET to gate-all-around.
This is the biggest shift in transistor logic in over a decade. I mean, FinFET was the 3D transistor that basically saved Moore's Law 10 years ago. But now, at 2 nanometers and below, FinFET just leaks too much power. It's becoming inefficient.
So the industry has to move to something new.
They have to move to gate-all-around, or GAA, where the gate material literally wraps all the way around the channel.
And AMAT's claim here is pretty bold. They said they're going to capture over 50% of the served market in GAA.
That is what they're projecting. And the reason, the key enabling technology they pointed to, is something called backside power delivery.
I love that term, backside power delivery. It sounds technical. But what does it mean in plain English?
Okay, so in a traditional chip, you have the power wires and the signal wires all crammed together on the top surface of the chip. Think of it like a city with only one level of roads. It's a traffic jam.
Right. Everything's fighting for space.
Backside power delivery essentially builds a subway system. It moves the thick, bulky power wires to the bottom of the silicon wafer. It separates the traffic.
And that does what?
This reduces resistance and improves power efficiency dramatically. But to do it, you have to do some pretty crazy things. You have to flip the wafer over, grind it down till it's incredibly thin, and then deposit metals with extreme precision on that newly exposed backside.
And that grinding and depositing. That's AMAT's machinery.
That is their sweet spot. And there's another material shift happening here that's just fascinating. They talked about the shift from tungsten to molybdenum, or moly, in the logic contact formation.
This is the changing the periodic table part you mentioned earlier?
This is it, exactly. Tungsten has been the workhorse metal for these tiny contact points for a long, long time. But at these new tiny scales, tungsten just has too much resistance. Electrons get stuck trying to get through.
They're trying to push water through a clogged pipe.
A perfect analogy. Molybdenum conducts better at that scale, but moly is incredibly hard to work with. You can't just paint it on. AMAT has a system called spectral ALD, that's atomic layer deposition, that enables this switch. They claim it reduces resistance by 15%.
15% lower resistance is a massive deal for a data center operator who's paying millions in electricity bills every month.
It is huge. It's a game changer for PUE, and it's a classic competitive moat. If you're the only company with the machine that can reliably handle molybdenum at scale, you win the business. Period.
Okay, pillar 1 was HBM. Pillar 2 was logic and GAA. Let's hit the third bucket, advanced packaging.
This connects everything together, literally. It goes back to HBM. As these AI chips get too big to manufacture in one single piece, we're hitting the physical limits of lithography. The industry is moving to chiplet stacking.
The Lego block approach.
Exactly. You build the CPU in one piece, the GPU in another, the I/O controller in a third, and you stitch them all together on a single package.
But the base plate for those Legos, the substrate, that's changing too, right?
It's getting massive. Customers want larger and larger substrates so they can package more GPUs and more HBM stacks together. So packaging is no longer just, putting a chip in a black plastic box. It's a lithography and deposition challenge in its own right, and it's one of the highest growth verticals for AMAT in 2026.
So we have HBM, logic, and packaging all firing on all cylinders. But we have to be balanced here. Not everything is booming across the board.
No, and that is a really important distinction to make. The lagging sectors are very clearly defined. NAND flash, that's the memory in your SSD, the storage memory, was described on the call as having modest growth.
So no big capacity expansion there. People aren't building brand new NAND factories.
No, it's an upgrade cycle, not a capacity add cycle. They're upgrading the tools they have to move to the next generation, but they're not building out new lines. And right now, NAND is less than 10% of total wafer fab equipment spending.
So it's almost a rounding error in the grand scheme of this AI boom.
In the context of the AI build-out, yes. And then there's the other big bucket of legacy stuff, what AMAT calls ICAPS.
ICPS. Remind us what that stands for.
IoT, communications, auto, power, and sensors. Basically everything that isn't leading-edge logic or memory.
The rest of the industry.
The rest of the industry. And that entire segment is flattish globally and flattish in China.
This is a crucial point for you, the listener. If you were betting on a broad-based economic recovery, lifting all boats, cars, washing machines, basic sensors, this earnings call did not support that thesis.
Not at all. The bull case is entirely and completely dependent on the AI stack. That's leading edge logic plus HBM. If you take AI out of the equation, the semi-industry is actually quite flat right now. This is a very, very targeted boom.
That is a vital nuance. Okay, let's pivot from the tech to the strategy. Operations, execution. They announced something called the EPIC platform. And no, they are not getting into video games.
No, although the name is pretty catchy. It's a co-development agreement, and the first major partner they announced is Samsung.
What does co-development actually look like in this world? It sounds good, but what does it mean?
It addresses a huge inefficiency in the industry. So usually, a chip maker like Samsung designs a new process in their research lab. They work out the bugs on a small scale. Then they try to transfer that process to a massive factory, a fab.
And I imagine that transfer process isn't easy.
It's a nightmare. Things that work perfectly in the lab just don't work at scale. It can take months, sometimes even years, to ramp up the yield to profitable levels.
And time is money. A lot of money.
Billions of dollars. The EPIC platform basically co-locates AMAT's own R&D engineers and tools with the customer. They're trying to shrink that time from lab to fab by developing the process on production scale equipment from day one.
So instead of AMAT guessing what Samsung is going to need 3 years from now, they are building it right there with them in real time.
Exactly. It gives Applied Materials much better multi-node visibility. They aren't flying blind anymore. They're embedded in their customer's roadmap. It's a huge strategic advantage.
Let's talk about the other side of the business, the services group, AGS. Because while the big, shiny new machines get all the headlines, the services business is what pays the dividend.
It's the cash machine, the annuity stream. Growth there was 15% year over year in Q1, and they expect low double-digit growth to continue.
Stable and predictable.
Very. But the interesting part is the tech they're using. They have this thing called the AIX platform that's Actionable Insight Accelerator.
More AI.
Yes, but this time they're applying it to their own tools. They have 30,000 of their machine chambers connected to this network, and they're using AI to diagnose tool health predictively.
How does that work?
So if a vacuum pump is vibrating just slightly differently than it should, the AI can flag it as a potential failure before it actually breaks and shuts down the production line. They're seeing 30% faster response times to issues.
That is incredibly sticky revenue. If you're a fab manager, you're not going to turn that service off.
You can't. It's mission critical, and the numbers show it. 2/3 of this service's revenue is recurring or under long-term contract. Renewal rates are at 90%. This provides the floor for the stock price. Even if equipment sales dip in a downturn, that services revenue keeps flowing.
We also have to touch on the legal side of things. There was a settlement that came up regarding the U.S. Department of Commerce and export matters. A $252.5 million accrual. That's a $250 million ticket.
It is an expensive one, but, the market pretty much shrugged it off. In fact, you could argue the market liked it.
Why would the market like a $250 million fine?
Because it's clearing the decks. The DOJ and the SEC have now closed their inquiries into the matter. The uncertainty overhang is removed. Investors hate uncertainty far more than they hate a known fine.
So it's a known quantity now.
It's a known quantity. They can model it. They know it's over. The check is in the mail. Let's get back to the business of selling tools.
That makes sense. Okay, one last operational note that caught my eye. Inventory. They build nearly $500 million in inventory year over year. Now, usually, rising inventory is a big red flag. It means stuff isn't selling.
Context is everything. In this case, management was very explicit. They stated they are prepping for a massive second half 2026 ramp. You don't build $500 million of incredibly complex, high-value inventory unless you have firm orders or extremely high confidence in those orders.
So it's a signal of aggression, not stagnation. It's pulling in parts for future build.
Correct. It aligns perfectly with the strong guidance. They are stocking the shelves because they know the customers are coming with big shopping carts in the second half of the year.
Okay, here is where it gets really, really interesting for me. We've covered the numbers, the tech, the strategy, but there was one piece of information on this call that I think is the most critical alpha signal for investors. And it wasn't about the chips themselves. It was about the buildings that house the chips.
The clean room constraint.
Let's unpack this because it's a huge deal.
Yeah.
Management said that growth in 2026 is being paced, literally limited, by customer clean room availability.
This is a physical reality check for the whole industry. We love to talk about cloud computing and these abstract concepts, but at the end of the day, chips are made in factories. Incredibly complex physical structures. You need vibration isolation, massive HVAC systems, high-purity chemical delivery lines.
You can't just, pop up a tent in the desert and put a $100 million lithography machine inside.
Not at all. So the customers, the TSMCs, the Samsungs, the Microns, they have the money, they have the demand from their customers. They want to buy the tools from AMAT right now.
Right.
But they literally do not have the square footage of certified clean room space to install them. The fabs are full. Management explicitly noted that if space were available, their 2026 growth would be even higher than what they guided.
So they are leaving money on the table this year simply because there's nowhere to put the machines. Now, if you're a short-term thinker, a trader, you might say, oh, that's bad. That's a cap on their growth for this year. But if you're a long-term investor,
it is fantastic news. It's the best news you could hope for because that demand doesn't just disappear. It gets pushed out. It spills over.
Into 2027.
Precisely. We know these new factories are scheduled to come online in 2027. Construction takes time. Because of this physical constraint, the peak of the cycle is being broadened and pushed out. It strongly implies 2027 will be another strong growth year. It completely debunks the fear of a 2026 peak followed by a 2027 crash.
This creates visibility. Usually in this industry, visibility is maybe 6 months, if you're lucky 9 months. This is giving us a line of sight that extends out 2 years. That is incredibly rare for such a cyclical industry.
It changes the entire risk profile of the stock. If you know the order book is effectively full, not just for this year, but for next year as well, because the buildings aren't even ready yet, you can hold the stock with much more confidence through any short-term volatility.
And when you look at that greater than 20% growth guide for semi-systems in 2026.
Right. If you break down the math, they're guiding for over 20% growth for the full calendar year. But given the slow start in Q1, and I'm using slow in very big air quotes here, this implies a massive back half acceleration.
The second half has to be huge to hit that number.
Huge. The exit rate for 2026 suggests they will be entering 2027 at a very, very high revenue run rate. The momentum is building, not fading into year end.
The train is speeding up as it leaves the station.
That's a perfect way to put it.
This is just a fascinating scenario. We have a situation where the biggest problem for the hottest industry on the planet is that we can't pour concrete and hang ductwork fast enough to house the money printing machines.
It's a very high quality problem to have if you're AMAT.
All right. We have crunched the numbers. We have looked at the constraints. We have analyzed the tech. Now it's time to get a little reckless.
Here we go. The fun part.
This is the part of the show where we must say, this is not financial advice. We are not your financial advisors. Please do not ruin your portfolio based on a podcast. This is for entertainment and educational purposes only.
Consult a professional.
But so, if we were sitting on a hedge fund investment committee this week, what is the trade pitch?
What are we pitching today?
I call this trade the concrete and cables clean room arbitrage.
Okay, I like it.
Or, if you prefer a different name, the 2027 spillover squeeze.
I'm listening. Lay out the setup.
Here's the setup. Everyone is long the chip makers like NVIDIA. That's a crowded trade. After this report, everyone is now getting along the equipment makers like AMAT because of the current beaten guide.
Also becoming a consensus trade.
Exactly. But the street, by and large, is still modeling a standard cycle. Their models are programmed to think that 2026 will be the peak year for spending and 2027 will roll over. That is the standard cyclical playbook that has worked for 30 years.
Buy the rumor, sell the news, and get out before the peak arrives.
Precisely. But the bottleneck we just identified, the clean room constraint, it almost guarantees that a chunk of this massive revenue wave pushes from late 26 into 27. The peak is actually a plateau, or maybe even a continued slope upward. The market has not priced in a strong 2027 yet.
So what's the play? How do you structure it?
Leg one, deep out-of-the-money LEPS. That's long-term equity anticipation securities, for those unfamiliar on AMAT, with an expiration date in early 2027.
Okay, so you're buying long-dated call options.
Yes, you are buying the options that expire right when those big new factories are finally opening their doors and AMAT can deliver all the tools they couldn't fit in 26.
So you're betting on that higher for longer revenue realization. You believe that Wall Street analysts will be forced to revise their 2027 models upwards throughout this year as the construction delays and the order backlog become more obvious.
That's the thesis. When the street realizes the backlog isn't vanishing, it's just moving to the right on the timeline, those 2027 calls will re-rate dramatically. But a good trade always needs a hedge. It needs a kicker.
Always. You need to protect your downside.
Leg two. You pair this long AMAT call position with a short on a basket of pure-play NAND producers.
Interesting. Why NAND specifically?
Because AMAT just told us, in their own words, that the NAND market is modest. It's upgrade only. Either the weak link in the semiconductor chain right now. If this whole AI trade wobbles, if the hyperscalers even sneeze and pause spending for a quarter, NAND collapses first.
It's a pure commodity. It has zero pricing power compared to leading-edge logic or HBM.
None. So if the market crashes, your NAND short pays out and cushions the blow in your AMAT calls. If the market rips higher, your AMAT leaps should far outperform because of this unique 2027 spillover effect that isn't fully priced in.
So you are hedging the general AI exuberance with the harsh reality of the commodity memory market.
You are betting on construction delays, forcing a supercycle that blows out the standard 2-year Wall Street model. You are literally trading the physical limitations of building factories.
It's an infrastructure reality trade. I have to say, I like the logic. It's built on a plausible, well-supported thesis from the call. It assumes the demand doesn't evaporate, but simply gets deferred. And given the AI roadmaps we've seen, that feels like a pretty solid bet.
It's wild, but it's plausible. And that's what we try to do here.
Indeed.
So, to wrap this whole deep dive up, what are the key takeaways for the listener walking away today?
Okay, first, a very strong beat and raise from Applied Materials. The fundamentals are rock solid right now. Second, AI and the data center build-out are the only game in town, but it is a massive, massive game.
And the specific drivers?
HBM and gate-all-around are the two key technical drivers you need to watch. That's where the outsized growth is coming from.
And finally, the big idea.
The clean room constraints are the hidden variable. That's the real alpha. They are pushing the cycle duration out into 2027, creating a much longer runway for growth than the market currently appreciates.
So keep watching those clean room build-outs. If you see news about factory construction delays, or conversely, new fab construction starts, that isn't just boring construction news. That is the pacemaker for the stock price of the entire equipment sector.
Absolutely, that's the tell.
Thanks for listening to Talk Tickers. We'll see you on the next deep dive.